Hi everybody, and welcome back to video number 3 in chapter 13. When we left off, we were looking at amortizing discounts or premiums using the straight line method. The more theoretically correct method is the effective interest method. And here we are going to compute the interest expense by multiplying the carrying value of the bonds at the beginning of the period by the effective, the market rate at that time. The carrying value or book value or amortized cost is the face amount minus any unamortized discount or plus any unamortized premium. And from there, we can determine the bond discount or premium amortization by comparing the bond interest expense with the interest cash to be paid. Let's look at how we do that. Again, we take the carrying value of the bonds at the beginning of the period times the effective interest rate, not the stated rate. Okay? The bond interest that we pay is what's written on the bond. It's the face value of the bond times the stated interest rate. And that difference will give you what we're going to amortize. Let's look at an example. Here, the Evermaster Corporation issued $100,000 of 8% term bonds on January 1, 2025 that are due 5 years later on January 1, 2030, with interest payable semi-annually on July 1 and January 1. The investors require an effective interest rate of 10%. Okay? All right, so what amount will investors pay for the Evermaster bonds, and what amount of discount will Evermaster record when the bonds are issued? So we go through that same calculation that we did earlier, and we find that the maturity value of the bonds payable is $100,000. Okay? Now the present value of $100,000 in 5 years using the effective interest of 10% here, for 10 periods, that's 5 years times 2 periods per year. And that gives us, from table 5.2, 0.61391. We multiply that through to get $61,391. Then we take the present value of an annuity, again for 5% in 10 periods, and we look that up in table 5.4, and that gives us a factor of 7.72173. Multiplied times $4,000 gives us $30,887. We add those two together, and we get $92,278. A difference or discount of $7,722. Okay, now when we make our interest payments semi-annually, we need to adjust the effective interest rate and the number of periods to calculate the present value. So let's take a look. Here is a lovely Excel spreadsheet, right? And here is our carrying value. That carrying value, you'll remember, is here. The proceeds from the sale of the bonds, initially $92,278. So what we do is we multiply that $92,278 times 5%. 5% is the effective rate, right? You'll remember that it was 10% effective interest rate, and half of that would be the semi-annual rate, not 8% or 4%. So what we do is we multiply that to get 4614. The cash we paid is going to be $100,000 times 4%, which is $4,000. So that difference is $604, $614, and that's what we're going to amortize as discount. And we add that $614 to the carrying value of the bond. And we go through the process again. We take 5% to get 46.45. We take 4% to get 4,000. We calculate the discount to be amortized. And you will notice that over the term of this bond, which is 10 periods, which is shown here, the carrying value ratchets up to $100,000 at maturity. So whether the bonds are sold at par, at a discount, or at maturity, they're going to be the same, $100,000 carrying value. Okay, so now when we do our journal entries, they're going to be slightly different in each period. The cash we pay, $92,278, that's how much cash we received. We recognize the discount of $7,722, and again, our bonds payable, $100,000. Now, the first interest payment, we're going to reflect we've credited cash for $4,000, but our interest expense is $4,614, which you will see is right off of the bond discount amortization schedule here. And so that difference is $614 as a credit. And then in December, it's slightly different, again, right off of the Excel spreadsheet we just looked at. Okay, now how do we present that on the balance sheet? So here's our current liabilities. We're going to show that we have interest payable that's going to be due within a year, right? Long-term liabilities, we have $100,000, but the discount on bonds payable, $64.63. That means our carrying value is $93,537. And that's how we take that same bond and show it in two places, right? Okay. Now, if there's a premium, the calculations are similar. I won't go through this again. I think you get it. But the effective interest rate was 6%. So when we go into the present value table, we're going to use half of that, which is 3%. But what we're going to pay is going to be based on 4%. So here we have a premium of $85.30, and you can see that we have our carrying value of $108,530. Again, our interest expense is going to be less than the cash we paid. We multiply 108,530 times 3% to get $3,256 here. And that difference is what we amortize. This time, the discount is subtracted each period, and it ratchets down to $100,000 over the maturity life of that bond. And our journal entries are very similar. We show the cash we received here, $108,530 is a debit. We credit premium on bonds payable for $8,530, and again, bonds payable $100,000. From the bond amortization schedule we did in Excel, we can pick off these numbers. Our cash is always going to be $4,000. That's what we paid. However, in December, once again, we didn't pay it in cash. We had interest payable because we're not going to pay it until January 1, 2026. Okay, so how would we report that balance? Same concept exactly as with a discount. Here we show the interest payable. We're going to pay that 1 day later on January 1, 2026. But our long-term liabilities here, bonds payable, $100,000. We have a premium on bonds payable, and that ratchets that up to $107,020 carrying cost, carrying value. Okay, in the previous example, the interest payment dates and the date the financials were issued were the same. If Evermaster wishes to report financials at the end of February 2025, it would need to prorate the premium by the appropriate number of months to arrive at the interest expense. So at the end of February, that means we would have 2 months. So the interest accrual is going to be $4,000 times 2/6, 6 months, or $1,333.30. The premium amortized is going to be the $744 off the Excel spreadsheet times 2/6, or a subtraction of $248. That leaves us with interest expense from January to February of $1,085.33. Okay, now if the company prepares its financial statements 6 months later, it follows the same procedure. Again, the premium amortized from March to June is going to be $744 times 4/6. The premium amortized from July to August will be $766 times 2/6. That total from March to August will be $751.33. Okay. Now, here we're going to record the fact that the Peloton company sold 12% bonds having a maturity value of $500,000 for a premium. So it sold it for $537,907.37. The market rate of interest at the time of issuance was 10%. So the bonds dated January 1, 2025 and mature January 1, 2030, that's going to be 5 years, and the interest is payable annually on December 31st of each year. Peloton allocates interest and unamortized discount or premium on an effective interest basis. So, alpha here, we're going to verify the price of the bonds and prepare the journal entry at the date of the bond issuance. Under Bravo here, we'll prepare a schedule of interest expense and bond amortization for 2025 to 2027. And then under Charlie, we'll prepare the journal entry to record the interest payment and the amortization for 2025. And then under Delta, we'll finally prepare the journal entry to record the interest payment and the amortization for 2027. So here's the solution for that. We calculate the value of the bond in the normal way. And then our journal entries, we're going to have cash that we receive, the premium, which we credit, and the bonds payable of $500,000. We create our effective interest schedule here in that same way, starting off with our carrying value, $60,000 being our cash paid, that's 12% of $500,000, and then our interest expense based on 10% of the carrying value. Okay, that looks like a good place to end this video, and when we return, we'll continue with looking at this accounting. Until that time, bye for now.